Hey, everybody, welcome, welcome. So, this is actually our vendor spotlight, and this vendor spotlight is a little different. We have Kanisha, the beauty CPA. Welcome, Kanisha. How you doing?
I am good. I am good and glad to be here. Thank you for having me.
I am glad to have you. So, guys, Kanisha is a CPA. Her business is Coleman Tax, and she specializes in working with beauty professionals. And today she has an awesome presentation for us. Tell us the name of the presentation again, Kanisha.
Absolutely. It is Tax Planning 101 for Beautypreneurs.
Awesome. I love it. Tax Planning 101 for Beautypreneurs. So I'm super excited for you to deliver this information. If you didn't catch her podcast interview last week, make sure you go on Business Beauty Network, on anywhere you listen to your podcast, Apple, Google, Spotify, and she gave some awesome tips there. But today she's going to be giving us a presentation. And so I'm going to let Kanisha take over. Are you ready, Kanisha?
I am. Let's go.
Awesome. So let's get it out here. You go.
Okay, wonderful, wonderful. But okay, so again, Brandy, thank you for having me. And I am very happy to be, presenting and sharing this information with your audience. It's so important because it's about money, right? And that's why we do what we do. I mean, we love the craft, but at the end of the day, we have got to live a prosperous life. So, Tax Planning 101 for Beautypreneurs. Again, I'm Kanisha Coleman, the Beauty CPA. And Coleman Tax, its goal, its mission is to help you keep more of your hard-earned money, right? We do that with effective tax planning and CFO services. Now, please do not get intimidated by the word CFO services. All that means, that's a fancy name for accounting and bookkeeping. So that's what we do. We provide tax, accounting, and bookkeeping services. And I'm trying to get you to a point where you are paying the least amount of tax legally possible. Okay. So, and that's what we're going to be talking about today. So I just really want to get into when I say tax planning, what is it and why is it important? And I'm going to move these slides here. There's a bit of a lag. But what is tax planning, right? Tax planning is simply arranging your financial affairs in a way where you are consequently paying the least amount of tax possible. That's all it is, right? So if you look at your business and you know there are very specific things that are going to happen in a given tax year, or let's just say you're setting up your business, there are things you can do to arrange your business and its activities in a way where you are going to pay the least amount of tax bill, right? And again, why is it important? Because you're going to keep more of your money, right? One thing I want us to take away, if you take away nothing else from this presentation, one thing I want you to take away is tax is not a season. I hear this a lot. Tax season. We're getting ready for tax season, as if it's something that comes and goes. And I want to change that perspective, that mindset, because as long as you are making money, as long as you're earning a dollar, you should be thinking of ways that you can keep most of that dollar and not give it away to the federal government or the state taxing authorities, right? So let's not think of it as a season. We should be thinking about this all year round. What can we do to keep more of our hard-earned money? Now, what I'm going to be talking to you today, it is a simple 6-part framework to identify tax savings throughout the year. This by no means, right, is this a substitute for a CPA, because when it comes to tax planning, it's so much to it. It's a huge world out there of possibilities of things we can do to make sure you're paying the least tax bill possible, right? But this is a basic framework that you can use, that you can at a minimum begin with. So let's go through the 6-part framework, right? We're going to first talk about business entity structures. And what does that mean? That means, how is your business organized? Are you a sole proprietor? Are you an LLC? Are you an S corporation? Or are you a C corporation or a partnership? Then we're going to talk about accounting methods. What method are you using to report the income you make and the expenses you incur in your business? Then we're going to talk about maximizing tax deductions and tax credits. We're going to talk about retirement planning, and then I have some tax loopholes that is going to surprise you. Again, these are basic frameworks, basic steps. I want you to keep in your back pocket and remember, and at least use as a conversation starter with, whatever accounting professional that you're currently working with. And if you're not working with one, keep this in your business like forevermore, just so that you can use it as a system to see if you can save money on taxes every single tax year. Again, tax is not a season. It's all year, because we want to keep as much money as we can. So business entity structure. This is step 1 of the 6-part framework. I get really excited about business entity structures because it's such an easy thing to do to save so much in taxes, right? So there are 4 basic structures, right? There are some other combinations of these 4 basics, but these are the 4 main ones you're going to hear about. You're going to hear about the sole proprietorship or the single member LLC. Now, the only difference between these two is the sole proprietor is like, okay, you just woke up and you said, I'm going to start a business. There you go. You don't organize anything with your Secretary of State. You just started a business. But then you can go an extra mile and actually register your business with your Secretary of State. And then that's when you become a single member LLC, one owner member, LLC. Then you have the general partnership, which means that more than one person, they started to go in business together. Or you can go an extra mile and register that business with your Secretary of State and you become a multi-member LLC. Then you have the S corporation, and that's when you are an LLC and you've elected with the IRS to be taxed as a shareholder corporation. That's what that S is for, a shareholder corporation. And then you can go full blown and incorporate your business and be a C corporation. Now, there is lots of tax saving opportunities when you're making this business entity structure. This structure would determine the way that you're taxed. And it also it can affect the way you take expenses. Because believe it or not, some are allowed for some entity structures and some are not for others. Or you can tax plan, and find the gray areas, the tax loopholes to take advantage of those expenses. So let's talk about the sole proprietor and the LLC for a second. I just want to make it clear that when you become an LLC, there's no tax advantages to that. The reason why that is stressed is because when you become an LLC, you get this added layer of protection from your state. So in the case that you are litigated against by a client or a vendor or whomever, that LLC separates your personal assets from your business. And so if you are sued and you lose, they could only come after the assets within the LLC. Your personal assets are off limits. So even though the taxing is the same for sole proprietorship and LLC, still go for the LLC. I get that question a lot. Should I go for the LLC? My answer will always be yes, because you want the added layer of protection. Now, I am no attorney, so I'm not going to go really deep into the litigation part, but I do know this. You do get an added layer of protection, but it does not protect you against malpractice. So if you are found to be gross negligent, the LLC won't protect you there. Okay. So when you're a sole proprietor, your biggest issue when it comes to taxes will be self-employment tax. And who's ever watching this now or on the replay, I challenge you, go look at your latest file tax return and look at the self-employment tax line. And that is the biggest tax issue when it comes to sole proprietorships, general partnerships, and in our LLCs, is because you are going to be really hit hard by self-employment tax. Okay. Now, introducing the S corporation. That is like the number one reason people change from an LLC to the S corporation, is to save on the self-employment tax. So when you're an LLC or a sole proprietor or a partnership, please, when your net income, revenue minus expenses, equals net income. When it hits around the 30,000 to 40,000 mark, start watching your self-employment tax, because you may benefit tax-wise by switching to the S corporation. Let's talk about the S corporation. When you become an S corporation, you will become an employee of your business. And so therefore, all of the net income from your S corporation will not be subject to self-employment tax, or FICA. That's what self-employment tax is. It's the FICA. It's the Social Security and the Medicare. And that's where you save money. So just think about that. As a sole proprietor LLC, all of your net income is being taxed at 15.3%. But when you're an S corporation, only your wage that you pay yourself as an employee is taxed at the 15.3%. You can get a distribution that completely avoids the self-employment tax as an S corporation. That comes with a slight thing you have to keep in mind. You do have to pay yourself a reasonable wage as an employee. That conversation is beyond the depth of what we're talking about today, but just keep that in mind. That's how you save as an S corporation. There will come a point where S corporation will no longer serve you, because once you hit a certain amount of income as far as your wages, you aren't subject to self-employment anymore. And that's where the C corporation comes in, because what will happen is the C corporation is being taxed at 21%, 21%, which is the lowest, could potentially be the lowest of all of these structures once you really start making the big money. So that's why people switch from S corporation to C corporation, because of that flat 21% tax rate, right? So remember that. So I know you're probably saying, okay, well, why not just be a C corporation out of the gate? And it's because when you're first starting out and you may not be making the big bucks, you may want to pull most of that income back out to support yourself. And the C corporation is notoriously known for double taxation. If you pull money out of that C corporation, you're going to be taxed at 21%, which is great. But then if you pull money out for yourself, you'll be taxed again at your personal income tax level. And we don't want that either. So remember that when it comes to entity structures. Now we're at step 2, the accounting methods. There are 2 main ones. There's some other hybrids, but there are 2 main big ones that is recognized by the accounting community, and it's going to be accrual and a cash basis accounting. I'm not going to spend too much time on this slide because most of you, if not all of you, should be using the cash basis method of accounting, which means that you're going to report your income. You're going to report your income as you receive it in your hand. If you did not get any cash or credit, if you didn't get the money right away, right when you delivered the product or service, you do not have to report it as income. And on the flip side, when you incur your business expenses, you do not report it as an expense until you actually expend the cash. It's out of your hands. It goes to whoever you paid it to. That's the general basis around cash basis. I put this in here though. One big example that I've been seeing as I have gone through this tax season this year is, since you are cash basis, and since the majority of you are considered small business making under 25 million a year, you should be expensing inventory when you purchase it. You should not be carrying inventory, on your books, especially not for tax purposes. That's important because if you were keeping inventory, that means that you're not getting a tax deduction until you sell that inventory. Versus if you don't keep inventory, you can expense it all right away. That's a huge difference. That could be a very huge difference in your tax bill. So take a look at that. I challenge you, go look at your tax return and you look at your, if you're looking at your Schedule C or whatever return you're filing on, I do not want to see cost of goods sold, because that means you're keeping inventory. I want you to expense all of that product that you buy right away. That's going to lower your tax bill. Just keep that in mind. If you take nothing else from that slide. So now we are on step number 3 of the 6-part framework, maximizing tax deductions. Believe it or not, this is such a simple concept. Of course, take all the deductions you can. And you, in your mind, you're probably thinking that you're doing that. But believe it or not, most beautypreneurs are overpaying in taxes because they are not taking all of the tax deductions that they are entitled to. And there are a couple of reasons for that. There are a couple of reasons. Look at this slide here. I say, okay, we cannot talk about this without addressing the elephant in the room. What is the elephant in the room, right? I'm not going to keep you in suspense much longer, but it is bookkeeping, guys. We have to do bookkeeping. And I know it's not the most exciting thing. It could be boring. It could be tedious. Maybe you could be thinking, oh, I could be doing something else with my time than looking at an Excel spreadsheet or playing within QuickBooks or whatever you use. But we have got to do bookkeeping because we cannot manage what we do not track. We cannot take as a tax deduction what we do not track, okay? You just simply can't. You will not remember everything that you spent in a given year come April of the following year when it's time to prepare your tax return. And that's why we do bookkeeping. So what is bookkeeping for all of you out there that may be new to this? It is simply the recording, reviewing, and categorization of your financial transactions. So every time you swipe that card and you spend some money, or someone swipes their card and they give you money, you need to be recording it in an accounting bookkeeping system. That could be something as simple as an Excel bookkeeping template, or you can use something more robust like a QuickBooks. Either way, you've got to track what you're earning and what you're spending. Let me tell you what is not bookkeeping. Bank statements are not bookkeeping. Merchant accounts, so that your PayPal, your Stripe, and whatever else is out there, that's not bookkeeping. Salon software, when they're swiping their card and then you could just see like what you're earning and what you're spending, that's not necessarily bookkeeping. So I want you all to start tracking on a regular basis and maintaining a bookkeeping system, because that is the key to maximizing your tax deductions. If nothing else, right? Number one, it's going to make your audits, if you are audited by the IRS or the states, it's going to make that a lot smoother. If you're audited and they see that you do not have records, they're not going to trust anything you give them in that audit. And that's going to open the door for them to go snooping wherever they want. I know, because I spent the first 8 years of my career as a revenue agent. And that's in fact what I did. So everything in this slide deck, which I can provide to you if you guys, you can message me on Facebook and I can slide this right to you. Anything highlighted in the slide deck is a link. I have linked in here a simple bookkeeping template for you to use if you do not have a system already. But again, you can't take all of your tax deductions if you're not even keeping track of them. So here, this slide is telling you, it gives you kind of some concepts to know what is deductible within your business. This is what I'm going to say, because I get this question a lot. What is deductible? What can I deduct? If it remotely has anything to do with your business, you deduct it. That's as simple as that. It's very few things that you can't deduct. You can count it on your hand how much things you can't deduct. Oh, one of the big ones is anything personal, right? Anything that has nothing to do with your business, you can't deduct. But if it has remotely anything to do with your business, you can take it as a deduction on your tax return. And so we have to start maximizing that power. A lot of people say to me, oh, well, Kanisha, I didn't take this because it seems so high, or it just seems so small. It's like, so what? A dollar is a dollar, right? I would never walk past $5 laying on the street and I didn't know who it belonged to. So again, this is highlighted here. This is a freebie for you guys. You click on the link, it'll take you to a 21-page document that will explain to you in layman's terms exactly what the tax deduction is, why it's important, how it can save you money. So you can check that out as well. Let's get to step 4, maximizing tax credits. Tax credits are powerful, way more than deductions, because it lowers your bill dollar for dollar. And really, people really don't pay tons of attention to the credits. The way they're reported on the tax return is in like they're like way at the bottom, like way past, like once you see your tax number, what you owe, you're kind of like over it at that point. You don't need to keep reading. But below that line is the tax credit section. And so we gotta, start utilizing those because they're better than deductions. If you owe $1,000 in taxes and you can find yourself $1,000 credit, you don't owe anything, you know? So it may be worth more time searching for credits than deductions. A lot of people come, what can I deduct? What can I deduct? It ain't about deductions. Credits are where it's at. Right here on these slides, guys, I have, again, this title is linked, so it goes to a video. But these are some common business tax credits that I want you guys to keep in mind. One that I really want to, there's two I want to point out. Research and development. If you are making your own product, R&D credit will be big for you. And a lot of you are making your own product. So keep R&D credit in your back pocket because you need credit for all those expenses you're incurring to develop your own products and conducting your own research. And then your retirement plan startup costs. We're going to get into retirement planning later, but if you decide to go ahead and create a retirement plan for yourself, for your business, you can get a credit for how much that costs to start the plan. And then this slide here, these are the personal tax credits. So not only do you have the credits for your business, you have credits that you can take advantage of in your personal life. One big one is all the ones related to, just having dependents and children. And, those are huge credits, and most of them are refundable, meaning even if you don't have a tax bill and you take that credit, that's just hardcore cash back in your pocket, So here's our retirement planning slide. Guys, we're not going to work forever. I know you love your craft, but we will have to stop one day, right? And so instead of playing the government here, I'm saying pay your future self. Pay yourself. Pay yourself. Why are we paying the government for? I just want to highlight the power of compounding interest, right? If we look at these inputs here, we have a 35-year-old going to work 30 more years to their 65. If they contribute $1,000 on a monthly basis at 6%, that money's going to grow to $1.1 million. That's a lot of money. That's a good retirement. And you don't have to start. One key thing I do want to point out, you don't have to start with $1,000 a month. You can start with $100 a month. The power of compounding interest will pay you back, like tenfold over 30 years. It will come out to be tons of money. So what I want to say is, use the power of time. That's what's big here when it comes to retirement planning is time, not necessarily the money, but the time. You can invest very little, $50 to $100 over 30 years can grow to multiple six figures. Here on this slide is 4 of the starter plans for solopreneurs or those with smaller teams. Look into these. All the contributions to these plans are tax deductible. All of them. So what does that mean? It's going to save you money on your taxes. And then the last step is we have to keep in mind our loopholes. Loophole sounds like a dirty word, but they are not. They are not dirty. This is one thing I'll say. I don't want to get political here. Here in these 6 on this slide, those are examples. I have a whole list of loopholes. These are just some starter ones that you can look into. Again, the underlined ones are all linked to videos to explain how they work. Okay. But do not be, my point in bringing these here is tax loopholes are legal, so take them to save money. I know all of you heard about the recent story about Donald Trump only paying $750. You know what he did that with? He did that with a tax credit. We just talked about tax credits. He did that with business credits. He was able to go from $7 something million down to 750, and it's legal. Okay, forget all that patriotic whatever, it's legal. So until they change those laws, you guys take those credits and those deductions. All right, here is a tax planning resource for you all. It is $47. You can get an extra 10 off with the code beauty, right? It goes into much more depth than what we talked about today, much more depth for each of the 6 steps. Check that out. You can save thousands if you implement some of the strategies that are in that guide. And then, if you want to hear more from me, if you want to speak with me, here's just how to find me on social media. On Facebook, I am at Coleman Tax. Again, if you want a copy of this slide deck, go ahead and shoot me a message, an inbox, and I will give the slide deck right over to you. And then I do have a text club. If you text the phrase beauty CPA to 21,000, you will get lots of discounts, freebies, and other tax tips to save you tons of money. So yes, guys, don't be afraid of taxes. Here's my parting words: death and taxes in life are certain, but knowing how only to pay your fair share is the third. So please remember that, guys. I hope this was helpful.
Thanks so much, Kanisha. Now for the links and everything, far as the freebie and the guide that you're selling, can you send me those links so we can pop them in?
Oh yeah, absolutely. I'll send you the slide deck right when we're done. Yeah.
Okay, great. And then, the links too, because I would have popped the links in, but I did include your website on here, and I also included your Facebook. That was an awesome presentation. Thank you so much for sharing. Make sure you connect with her. If you have any questions for her, connect with her on Facebook or Instagram, inbox her, ask her questions. And what's the text club again? I'll pop that in real quick.
Oh, absolutely. It is the phrase beauty CPA to 21,000.
Okay, yep, beauty CPA. Right, so I did pop that into 21,000. And I am super excited. I think this was some great information, and I love what you share. So thank you so much. This will be up for the replay, so if you missed any of it, you could go back and watch it. And Kanisha, did you have anything else you wanted to share with us before we go?
I would just say, guys, hey, do not get intimidated about tax and or accounting. I am here to help you. If you need help or you need guidance, I would just say, don't overpay in taxes. That's something we do not want to do. That money can be better utilized to invest back in yourself, in your beauty business. So please do not overlook this whole, tax planning concept. Okay.
I know, because you told me some things that I didn't know, and I do believe like loopholes is like usually people think that is a bad thing, but
it's a dirty word, right?
But if you're giving us some ways that we could save money, I got to figure out. That's one thing I can say that Donald Trump did right, and so I definitely have to figure out like how, like if he can make all that money and only pay $700, then how can we do the same, right?
No, right? $750, y'all.
Right. Mm-hmm. But thank you so much. This was definitely some valuable information, Kanisha. And I know we're going to be seeing you at the summit. Mm-hmm. So definitely, I know Kanisha's going to be hanging out with us at the summit. And make sure you text her and get all the information and connect with her. She definitely can add some value to you and your business.
Absolutely. Thank you, guys. Thank you for having me. This was a pleasure. It was a blast.
Thank you. And that's all we have for you today. So as always, stay great. And we hope to see you at the summit, the 25th through the 27th. You can get your tickets on Eventbrite. I'll pop that link in as well. Bye.